There is a $3.5 trillion financial system operating right now that most people have never heard of. It doesn't answer to regulators the way banks do. It prices its own assets using its own math with no outside verification. It has been lending money to companies that traditional banks specifically decided were too risky to touch. And right now, the people who built this system are quietly restricting withdrawals, hiding losses behind accounting tools that have a nickname, and that nickname is amend and pretend, and hoping that nobody notices before they can figure out what to do next. It's called private credit, and it's the financial system that's quietly breaking. To understand how we got here, you have to go back to 2008. Because the 2008 financial crisis wasn't just a housing collapse, it was also a regulation story. After the crash, Congress looked at the banks, decided they had taken on way too much risk with way too much borrowed money, and passed a set of rules designed to stop that from happening again. Banks had to hold more capital. They had to pull back from the riskiest kinds of lending. They had to be more conservative, more transparent, more boring. And for the most part, that's what happened. The banks got more boring, which left a gap, because the companies that used to borrow from banks still needed money. The buyouts still needed financing. The mid-market companies that were too small for Wall Street and too big for a local bank still needed loans. And right on cue, a new industry stepped in to fill that gap. Private credit. Non-bank lenders, private equity firms, asset managers, insurance companies, funds started lending directly to businesses outside the traditional banking system, outside the regulations, and outside the public markets. And the pitch was simple. Higher yields for investors, faster capital for borrowers. Everyone wins. From 2010 to 2026, the market exploded from roughly $200 billion in assets to over $3.5 trillion. That's not a niche corner of finance anymore. That's bigger than the entire high-yield bond market. And here's the part that should make you uncomfortable. Almost none of it operates under the same rules as a bank, which brings us to the mechanism. Because the way private credit actually works is the reason this whole thing gets interesting. When a bank makes a loan, it has to mark that loan to market. Meaning, if the loan starts losing value, the bank recognizes that loss on its balance sheet immediately. Painful, but honest. Private credit funds don't have to do that. They get to mark their loans to model, meaning they value loans based on their own internal math rather than what the market would actually pay. Private credit funds can be sitting on loans that are quietly deteriorating. Borrowers missing payments, covenants being waived, while the fund's official valuations say everything is fine. The industry even has a term for when a struggling borrower can't pay cash interest and just adds it onto the loan principal instead. It's called payment in kind. The fund books it as income. The loan balance grows. The underlying company gets deeper into a hole, and everyone pretends the music is still playing. It's the financial equivalent of paying your credit card bill by increasing your credit limit. And it has been happening at scale. Here's where the numbers get ugly. As of early 2026, private credit default rates sit somewhere between 5.8% and 9.2%, depending on who you ask and how many shadow defaults they're willing to count. For context, the historical average for investment-grade bonds in a normal year is under 1%. In 2008, at the absolute peak of the financial crisis, corporate loan defaults hit 10%, a number people called catastrophic. Private credit is already in that neighborhood. And analysts at UBS have warned that if AI disruption keeps eating into software revenues, and roughly 30% of private credit portfolios are loaded with software loans, defaults could peak between 13 and 15% by the end of 2026. And then there's the withdrawal problem, because this is where the system starts to look less like a sophisticated investment vehicle and more like a very fancy trap. Private credit funds raised billions from retail investors by offering something called semi-liquid structures. The pitch was elegant. Get the high returns of private lending with the occasional ability to take your money out. It sounded like the best of both worlds. And it worked beautifully in 2021 and 2022 when everything was going up and nobody wanted to leave. But now investors want out. Blackstone's $82 billion private credit fund received $6.5 billion in redemption requests in the first quarter of 2026 alone. Nearly 8% of the fund trying to exit at once. Ares Management capped withdrawals after redemption requests hit 11.6% of its fund. Blue Owl was forced to permanently restrict withdrawals from one of its retail vehicles. These are not small players. These are the giants of the industry. And they are all doing the same thing at the same time, locking the door. Now, why can't they just sell the loans and pay investors back? Because the loans are illiquid. They're private. There's no exchange, no market, no bid. If you need to sell a private credit loan quickly, you either find a desperate buyer willing to pay far below face value, or you don't sell at all. So these funds built on the promise of occasional liquidity are now discovering what happens when everyone wants liquidity at the same time, and the underlying assets have none. The industry has a polite word for this. They call it a liquidity mismatch. What everyone else should call it is a structural design flaw that was obvious to anyone who thought about it for more than 30 seconds. Here's the historical rhyme that nobody's talking about. In the early 2000s, the mortgage industry packaged home loans into securities, priced them using internal models, and had them rated by agencies that depended on the issuers for their fees. They were considered safe right up until the moment they weren't. When housing prices stopped going up, the models broke, and $11 trillion in household wealth evaporated in 18 months. Private credit isn't a perfect replay of 2007. The capital structures are different and the leverage is lower. But the ingredients that made 2008 so devastating, opacity, self-reported valuations, interconnectedness, hiding behind complexity, and a promise of liquidity sitting on top of fundamentally illiquid assets, those ingredients are all present. Even Jamie Dimon reached for the cockroach analogy when the first major private credit collapses hit in 2025. When you find one cockroach, there are usually more nearby. And what happens when it spreads? Because private credit didn't grow in isolation. The banks everyone assumed were now safe because of post-2008 regulation, have significant exposure to private credit funds through warehouse lines and direct lending to the funds themselves. Estimates suggest banks finance roughly 30 to 35% of private credit fund operations, which means if this breaks in a serious way, it doesn't stay in the shadows. It bleeds into the regulated banking system through the very connections that were supposed to be contained. The risk wasn't eliminated after 2008. It was relocated, given a different name, and told to keep its voice down. But here's the uncomfortable truth. This industry grew from $200 billion to $3.5 trillion, specifically because it operated outside the rules. The yields were high because the risk was high and the transparency was low. And for a decade, zero interest rates and an endless bull market made the risk invisible. Now rates are elevated, defaults are rising. AI is dismantling the revenue models of borrowers that make up a third of these portfolios, and the maturity wall, over $620 billion in private credit debt coming due in 2026 alone, is arriving at the worst possible moment. The system wasn't designed to be tested. It was designed to be profitable. And those are not the same thing. So the next time someone tells you the financial system is safer now than it was before 2008, ask them one question. Safer for who? Because the risk didn't disappear. It just moved somewhere nobody was legally required to report it. And now it's $3.5 trillion deep, the withdrawals are being gated, the valuations are being questioned, and the people who said this was different from 2008 are starting to sound a lot like the people who said housing prices never go down. Where do you land? Is private credit a manageable shakeout in an otherwise healthy system? Or are we watching the first cracks in something much bigger that the headlines haven't caught up to yet? Drop your take in the comments, because if history has anything to say about it, the time to have that conversation is before it becomes obvious, not after.